I pointed out this crucial pattern and warned of a big market sell-off the day before the sell-off began on August 1st. Don't believe me? Check out my video, What Just Happened in the Markets, linked above, which was released the night before on July 31st. Now, there is an even more significant pattern that is almost near its breaking point, which we're going to cover in today's video. If you want to stay up to date on these market moving updates, please consider subscribing and tapping that notification bell. Let's start things off with SPY on the 2-hour. Just to quickly explain everything we see here, we had this descending channel that the market was breaking into and out of for a little bit. And then we had what I called out in my last video, what looked like it was a bear flag, these red lines. And now we can see we've actually broken above that. Now, the main thing that's on my radar is what looks like, and this is in purple, this rising wedge pattern where for now we appear to have broken above the resistance line of it. But if this is just an exuberant breakout and we're going to have a following crash, that's targeting about a 13-point sell-off. We touched the 100% retracement from where we first sold off back on the 1st, but we're dangerously close to this previous support line of this massive rising wedge pattern that we keep following. Around 560 to 561 on SPY and around 56.25 or 26 on SPX. Sometimes rising wedge patterns can sell off and reach their pattern targets very quickly, but particularly in bull markets, we can often see one last attempt to push higher. If this previous support line acts as resistance, we could see an absolute sell-off even worse than what we saw between August 1st and 5th, finally heading towards around, let's say, 4,700 for SPX. And somewhere in the 480s for SPY, because you have to recall that pattern targets move from wherever the initial breakdown first happens. These RSI patterns, they just don't look bullish to me. This looks forced. If you go back and look at the RSI for all of 2023 and the first quarter of 2024, you will see what a true bullish market looks like. And one thing that's very important to pay attention to is volume. These little light blue things in the background, that is the volume. Notice how starting with August 1st, we had increasing volume up until on August 5th, when we had our bottom. Obviously, we had a lot of volume on that day because there was a big battle between the bulls and the bears, and the bulls won, and we began to push back up. But as you can see, volume has kind of dropped off a little bit here, which makes me question just how sustainable this actually is. And if we throw up the daily moving averages, we can actually see that right now we are way above the 200 simple moving average, around 505, way above the 100-day simple moving average around 530. We're above the 10, the 21, and the 50. So we're extended above everything right now, which is a pretty bullish sign. But as you know, markets don't move in straight lines, so when you get that far extended, they like to snap back. And if the market does manage to get above all of this resistance, this big cup and handle pattern that we've covered before, from like right here to here, we had the cup and the handle, that's still targeting around 578, 577. So we could even see that pattern target finally get fulfilled and then get a sell-off. And if we zoom all the way out to the monthly time frame, we can see there's some pretty obvious bearish divergence that's forming. It doesn't mean that we're going to crash right away, but it is signaling that this is coming. And just to give an example from history, let's look left a little bit. Just look at what happened between June of 1996 to August of 2000. The market was making higher highs, but the RSI was making consistently lower highs. And then we see what happened in 2000. We had a roughly 78-point sell-off, which at the time was a 50% sell-off. Like I covered in a previous video, even that didn't go in a straight line. We had these pretty significant bounces in between. Markets are like a boat floating in the ocean. When the ocean is calm, the boat floats up and down in minor ways. But then when something happens that spikes a huge wave, the boat is at the mercy of that wave, and then large but increasingly smaller waves bounce around until it's back to calm seas. Market catalysts make the waves. The tsunami that we saw on August 1st made a huge wave, leading to all of this volatility. Then as the market decided on a direction, we saw 7 days straight of steady buying. But can it continue? Next week, we've got multiple economic catalysts coming up, including European CPI, which could affect the dollar's strength, a few Fed speakers, the FOMC meeting minutes on Wednesday. But I think that Thursday and Friday are going to be the most significant days for catalysts. We have initial jobless claims that comes out at 8:30 on Thursday, and we better hope that that doesn't come in really soft. And then the big one is Jay Powell speaking at the Jackson Hole Yearly Symposium at 10 a.m. on Friday. And the whole market will be hanging on his every word, trying to figure out if rate cuts are assured in September and how much basis points they're going to cut by. It appears that the market is already pricing in the first Fed rate cut. And the market is always forward-looking. That's why it's often when the economy is at its worst that the market is already rebounding. I'm keeping in the back of my mind the Fed's SOM rule recession indicator for unemployment. It's already been triggered, and this thing has not been wrong before in predicting recessions. Plus, yield curves look closer to re-steepening. It's always the re-steepening that leads to recessions, as capital floods out of equities and into safe places for yield like bonds. We can see how this spiked up back during the COVID lockdowns. And then we also have hit above this 0.5 key level now. When we take a look at the VIX on the daily, we can see we had a bit of an RSI double top. Now appears to be forming a base around 35 to 36 on the RSI at the same time that we're at this lower support line of this longer running ascending channel. We appear to be trying to form a base on the 4-hour time frame, but the lower support of this channel has to hold. If it doesn't, I suspect we may actually see the VIX head back down around 12, which is a much stronger lower support of this huge megaphone pattern and has confluence with this previous resistance line that we broke out of. And when we zoom back into the 15-minute looking on a multi-day time frame here and we draw a little bit of a trend line here, we can see that we had a descending trend line. Every time that we touched this, we bounced back down. We've now broken above that. It doesn't mean that we couldn't continue lower, but that main trend of decreasing fear, we're away from that now. Taking a look at Dixie on the 4-hour time frame, we can see a pretty well-defined descending channel. You got to keep in mind that on the days that Dixie hits either the support or the resistance lines of this channel, the dollar is likely to bounce or reject strongly, and the overall market is likely to react to that. Typically, a strong dollar equals a weak market and vice versa. I have to wonder if the day that the dollar comes down here and hits this support line and starts bouncing sharply, if that's going to be the day that the market starts a reversal. Feel free to take a screenshot of this channel if you'd like to add it to your own trading setup. Zooming out to the daily, I have noticed something on the RSI, and I'm going to draw a little bit of a trend line here so you can see it. This appears to be forming a descending triangle, which tends to be a bullish breakout pattern. Once the market can't get any weaker, it actually breaks out to the upside. And also, Jack with Nobody Special Finance did an analysis on the US dollar versus the Japanese yen and found that it is very likely that, rather than it being unwound like multiple big firms have asserted and possibly even lied about, it appears instead that investors have piled right back into it. The video is linked above. If that's true and it begins to unwind again, we will likely see the dollar sell off again along with the markets. Long story short, when this kind of trade unwinds, the people behind it are forced to sell assets that they bought, like equities, then sell the dollars that they got from them to buy the Japanese yen, which lowers the dollar and strengthens the yen. As a bonus, before we get into the pattern that I mentioned at the beginning of the video, I want to point out what I'm seeing on Apple. We have a daily gap at 232.33, and it appears to be forming a rising wedge pattern, which is targeting a roughly 18-point drop if it plays out. If the market is just going for a gap fill before a sell-off, we could see it reject sharply once it fills that gap. Considering that Apple accounts for close to 7% of the S&P 500 weighting, it could absolutely bring the overall market down with it. And real quick, I wanted to share that I frequently share market updates on the YouTube community tab for whenever I don't have time to make an update video, just like you see here. I also post stuff like this on StockTwits as well. So here it is. Here's the pattern you've all been waiting for. On the 1 hour time frame of the ADD, this appears to be forming an ascending triangle pattern, which is often a bearish breakdown pattern as the bulls cannot break above the unbreakable resistance. Although it can also be a bullish breakthrough pattern, often leading to an explosive move up in the markets. The previous rising wedge pattern that I pointed out took 8 days to form before breaking down. So far, we are 9 days into this pattern and it's nearing its apex. If we zoom out to the 2 hour, it actually appears to be more of like a symmetrical triangle, which is always an indecision pattern and can be very difficult to predict which way it's going to break. If we look at the RSI even kind of looks like a symmetrical triangle pattern. And remember that with symmetrical triangles, there is very frequently a false breakout followed by the real move. So once this breaks, there is the absolute possibility that the market breaks in one direction, possibly for a day or so, and then sharply reverses. This is not financial advice, but I would definitely hedge accordingly. And it's not very often that I zoom all the way out to the weekly on the ADD, but when we zoom out, I believe that this becomes clearer. You see this obvious shooting star candle showing how the bulls pushed the market way up, but the bears were even stronger to push it back down. In my mind, we shouldn't be fooled by the market's V-shaped recovery. It's gone up on relatively low volume, and there is the potential it could dump even faster. There's always the possibility that the market just keeps pushing up and I could be completely wrong, but I'm trying to follow the technical signals. I want to quickly share my thoughts on something that I find to be concerning. Consumer spending is strong, but it's being financed through debt. There are record high credit card delinquencies and net charge-offs, all of which have historically preceded recessions. I suspect that there's a mix of things causing this. One, many households can't even afford basic necessities and they're being forced to charge them on credit. And two, many actually believe the Fed has engineered a soft landing and are expecting rates to go lower and the economy to pick up soon. They're thinking, I don't have a job now, but I will soon. Historically, soft landing expectations have been the highest right before a recession. If you're loving this content and think someone else could benefit from it, please share my videos with someone you think will love it so that as many people as possible can benefit. And stick around for today's trading rule to live by. As always, nothing I show is financial advice, and best of luck, cool cats.